Thank you for joining us with our webinar with Pender Capital Management on investing in small caps. My name is Jeff Hunter. I'm Associate Portfolio Manager with Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line are our Senior Investment Advisors, Dave Townshend and Raheem Somani. Today's call may contain forward-looking statements and is being recorded, so make sure to check your email in the coming days for the replay information. It should be really exciting. I think the timing's great. Pender is ranked in the top percentile for their 5- and 10-year returns by Morningstar. That's quite an accomplishment to be ranked in that percentile with all the competition there is. Today we are joined by Ian Collin. He's a VP of Business Development with Pender, and I'll pass it over to Ian.
That's great. Thanks very much, Jeff and David and Raheem. Very good partners with Pender. It's really a pleasure. We're very fortunate to have Amar Padia here on the webinar with us. He's been at Pender for 6 years, and he's certainly a key part of our small cap investment team. He also manages and is lead manager in the Pender Alternative Special Situations Fund and the Pender Arbitrage Fund. I think to Jeff's point, we are seeing historic lows in the small cap market and a setup similar to 2009, where a lot of these small cap companies were priced for bankruptcy. Amar and the small cap team have done a great job in the past picking through the rubble and finding these great companies that capture gains going forward. So we're very excited as most of the attention is in large cap tech. A lot of these very good businesses in the small cap area have been orphaned and have not received capital. So Amar and the team are able to pick the very best ones. With that, I will pass it over to Amar.
All right. Well, hello, good morning, everyone. Thank you very much for listening in. So as Ian mentioned, I've been part of Pender Fund now for in excess of 6 years, initially working as an analyst before taking over a couple of mandates for the firm. And I work alongside the team in helping find ideas and running the Pender Small Cap Opportunities Fund, which we'll be discussing today. Perfect. Yeah, so here's the agenda for the presentation, a bit about who we are. So Pender is a small cap focused investment management firm. We're based in Vancouver, Canada. Our origination, where the firm was founded in, was in venture capital, primarily focused on small Canadian technology companies based in the BC and Vancouver market. And then we moved from there into investing in small cap securities and have expanded subsequent to that into the alternative and fixed income space as well. We're a fully independent employee-owned firm. We invest alongside all of our clients within our various funds and strategies that we run. And what we're focused on primarily is the inefficient parts of the market with concentrated high conviction portfolios where we do rigorous work to understand and analyze businesses before owning them, thinking like an owner and understanding the incentives of management and the entrepreneurs that run the business. The strategies that we run are typically nimble, opportunistic, and they allow us to deliver positive investment returns that have been stress tested through the market cycles. So in terms of Pender's investment team and the various strategies that we run within the public equity universe, Pender has about $500 million of capital across a wide variety of different investment strategies, typically in the small cap space, as well as fixed income and then ventures as well. So getting involved in companies across the business cycle when they're private to when they're a large company that can issue fixed income in the market. So all parts of companies, all parts of the business cycle, that's kind of where Pender focuses. So a bit about the small cap investment team. So the fund is led by our CEO and portfolio manager, Dave Barr. He's been investing in the small cap space since the early 2000s. He joined Pender in 2003, was primarily focused on the venture side of the business and moved into more of a micro mid-cap focus. Myself, as Ian mentioned, I joined Pender in 2017. I focus on more special situation and arbitrage opportunities that we own within the small cap fund. And then the fund itself has 4 other members of the team with a wide variety of specializations and backgrounds. And then we're fully supported by 12 additional investment team members across the fixed income, venture, and equity side, as well as Pender's operational and marketing staff. And so talking about small cap equities and how Pender identifies and chooses to invest in businesses, a big part of our process is understanding what companies can provide long-term value. And the way we kind of go about investing in them is starting from an idea generation perspective. A big part of what we like to do, where we typically leverage the best ideas, is what we call recycling previous ideas and competencies. So it's knowing the industry very well, understanding a specific business, let's say the technology space, and then investing in a peer or a competitor as they emerge within the industry, and leveraging all the competencies that we've built into this new investment. We also, are constantly reading, understanding how the markets are changing and evolving, what new companies are coming into the market. We like to clone, so looking at some of the best investors that we admire, that we talk to, and building up similar sorts of investment theses on these businesses. We do a lot of talks with management teams, go to conferences, do some screening, and in some cases, third-party research. But it's really leveraging the organic competencies that we have in terms of what we invest in. In terms of what we do from a security analysis perspective, what is our edge? So it's a very much a deep fundamental approach to analysis. There's a term called scuttlebutt that we like to undertake. So it's not only speaking with management team and trying to understand a business that we're seeking to invest in, but it's also thinking about the management team and their incentives, their customers, their clients, their peers and competitors in the industry. So building a mosaic of information that allows us to understand the business like an entrepreneur and see it from their perspective. And we really consider ourselves business analysts, not investment analysts. So we're trying to understand the value of a business and seeking to acquire it for less than what we think it is worth. From there, there's a variety of filters that we undertake that are typically proprietary to Pender. So it's understanding, is this company within our circle of competency? Historically, Pender's focused primarily in the technology space. That's a big part of where we invest in. And that's an area where we have a lot of insights and value and that we can leverage and add into our strategy and process. We also evaluate companies through a trinity of risk as well, understanding the business risk and the balance sheet risk of that business. And then a wide variety of proprietary predictive attributes that we use as well. So things like investing in companies that are founded by or that are led by their founder CEO. If you were to look, at the S&P 500 or the Forbes list of who are the wealthiest individuals in the market today, it's the Elon Musks, it's the Mark Zuckerbergs, it's the Bill Gates, it's CEOs that are they're founders of companies that ultimately were the CEOs, and that's ideally where we like to invest in the small cap space, is finding that right founder of that business who can grow this business for the long term, who's a visionary, and who can create long-term value for the shareholders. Within the small cap space, it's really important to build and understand the portfolio that you choose to invest in. So managing concentration thresholds, estimating risk, understanding what are the return potentials for the various investments that we have, minimizing the drawdowns, and knowing how to trade smaller cap securities is a big part of how we focus and run our strategies. Next slide. So in terms of our philosophy, I touched on some of these points, but what we're seeking to ultimately do is understand the quality of the business and then obtain more value from that business than what we're paying. So after we understand what is the intrinsic value of this business, what is it worth to another party, having that built up and then trying to buy it at a price point where we're paying less than that ultimate value. We deploy it across a variety of flexible mandates. And then we also have a large focus on risk mitigation as well. So minimizing the downside in the investments that we choose to invest in within the fund. As I touched on, a big part of what our strategy's done is leveraging that initial private equity background that Pender had. And we call that the private equity approach to public markets. So just like in private equity, you're making an investment, it's effectively permanent. There's no other way to get your money out besides an IPO or a sale. So it requires a deeper level of thinking, due diligence, analysis to understand ultimately what is this business worth, what are the incentives of management teams, how do you assess their quality, how do you know they're going to grow the business? And we apply that similar type of analysis and due diligence to the public small cap companies that we invest in. In many cases, we work with these companies. So, we're providing advice, In some cases, we're getting on their boards as well to help them achieve their, their long-term goals. We focus a lot on understanding the incentives of the management team. So when there's a founder of the business, what are his or her incentives? What are they seeking to achieve? Are they that visionary that's looking to build something unique for the long term? Are they, more financially motivated? So really trying to understand that dynamic. And in some cases, we're getting involved to drive a liquidity event or exit as well. So we're there's a potential for this business to be sold or for them to sell an asset. And, we're working with them, or we're discussing with management the ability to do that and transact on it, and always trying to get value out of these investments. So we're looking to buy $1 of value, typically for 50 cents. So, as we mentioned, a big part of how we're different and, differentiate from the market is the fact that we use the scuttlebutt approach to research and due diligence. So it's going above and beyond to understand the business, but also the market they operate in, the incentives of the various members of the management team, and ultimately what other market participants that could acquire that business view and think of that company. And so in terms of the small cap space, what are the kind of key drivers? How do we look to identify? We use a real disciplined process for identifying high quality businesses that we think can generate long-term potential returns. So a big focus is understanding the underlying unit economics of our company. So for every unit sold, what are the costs associated with it? How much value can they extract? What are the margin profiles of that unit? The growth runway. So the total addressable market is something that we really try to understand, particularly in smaller companies. If you're in a new industry or you're servicing, a part of the technology sector where large incumbents are, what does that growth runway look like? So how long can you grow? How much could you grow? How much could that market you're involved in grow? And that's ultimately going to drive the long-term success of the business. Understanding their competitive advantage, so how they fit within the market, who are their competitors, what are the advantages that they have that are likely to drive long-term growth, that are likely to win them business and more customers, and then ultimately the execution. And particularly in the small cap space, execution is really the primary factor that's going to drive success. Management is much more critical for small cap businesses. Warren Buffett has, a saying that, you want to buy a business where a ham sandwich could run it. And that's just not the case in a small cap company, where that management and that management team is going to be far more critical in growing and executing on the growth outlook and the growth strategy for that company. So again, how we're different, working with investing companies. So not only are we investing in the business, but we're also partnering up with management and the board in many cases to actually help them and enable them to grow for the long term. As mentioned again, so driving liquidity or exit event. So, Pender has this very unique track record of identifying takeouts within companies. So since the mutual fund business was launched in 2011, 83 of the companies that we've invested in have been ultimately acquired out of our equity funds. It's a big part of where we focus. And in the small cap space, the reality is that there's just far more acquirers for businesses. If you're a smaller company, more companies are seeking to acquire the competencies that you have, the human capital that you have, the capabilities that you have. So if we can get involved, invest in these companies prior to that acquisition, help them move towards that liquidity event, that can be quite additive to long-term performance. And that's a big part of what has generated the success that we've had within the Pender Small Cap Fund. So moving to a bit about an update on small cap universe and the markets. So 2023 has really been a story about mega caps leading the market. So on a year-to-date basis, the S&P 500 and the NASDAQ are both up quite substantially. But what's driven that gain, about 75% of it, has actually been 7 mega cap companies. So Apple, Nvidia, Microsoft, Amazon, Meta, formerly Facebook, Tesla, Alphabet. Those 7 companies have driven about 75% of the returns in the S&P 500, while the remaining 500 companies within the index have typically underperformed. So really a year that's been dominated by those mega caps, and that's created a lot of opportunities within the smaller subset of the market. Just to show that more illustratively, so looking at the S&P 600, which is an index comprised of 600 small cap businesses, and then also the contrast between small and large cap companies, you can see that the valuation for small cap businesses are at all-time historically attractive levels. So they haven't traded at these levels since the great financial crisis on a relative basis, small to large cap. Also at unprecedented levels. So a very attractive opportunity to get involved investing in small cap companies that have really lagged the market. And these are great businesses that we're focused on that are trading at very attractive levels, have great outlooks, and the potential for them to ultimately be acquired as well. So very much a unique situation where there's just a lot of opportunity within this universe. As mentioned, valuations have been quite extended for that large cap space. So of those 7 companies mentioned that have driven 75% of the returns in the S&P 500, it's really been driven by multiple expansions. So just the valuations of those businesses increasing. So nothing really to do with their fundamentals, their earnings, their cash flow, their growth outlooks. A big part of what's driven that performance has just been the expansion of their multiples. And like an elastic, what goes up can come down, and is likely to. So, we would rather be in a part of a universe where valuations are at all-time or near trough levels, where there's a very attractive fundamental outlook, it's less likely to see a contraction of those multiples, just given that gap between small caps and large caps. What we're seeing within the technology space and the broader markets is a very similar circumstance to the early 2000s with the tech bubble, where unprofitable companies lagged in the early 2000s, but those that were successful and achieved profitability were ultimately, the businesses that were leaders in the future, and they outperformed. And it's a very similar circumstance today, where over the last few years, there's been hundreds across North America and dozens within Canada of public companies, predominantly in technology space, that have gone public. Many are on the verge of profitability or profitable, and that's really where we're focusing. So we see a lot of strong parallels between that 2020 tech bubble and the current market that we're in, where we're focused on investing and identifying those winners that are ultimately going to be long-term outperformers in the markets. So again, looking at that tech bubble rally, what we saw coming out of the tech bust and bubble was very strong outperformance by small cap companies. This is driven by, as I mentioned, just these companies moving towards profitability, and then their fundamental outlook improving, and the market investing in them, but also just the extended valuations of those large cap companies coming down as well. So a similar circumstance where we think large cap businesses, particularly those mega caps, could be overvalued, and also a very attractive setup for those small businesses that are fundamentally undervalued and have very strong positive outlooks. Again, in terms of the market update and the outlooks, and we're really seeing a lot of parallels to early 2000s with narrow leadership in the large cap tech space. A narrow setup where there's a small subset of large mega cap companies that are extending their valuations. They're not growing into them. A lot of potential for those multiples to contract and re-rate lower. And then that's contrasted by small cap businesses that are trading at their widest discounts since the 2000s. Really, we see an attractive setup where they could be outperformed on a multi-year basis. So, we think the small cap part of the market is very attractive right now, and it's filled with opportunities. So talking a bit more about the actual Pender Small Cap Opportunities Fund and the various positions that we hold. So you can see across the top 10 holdings, and then also on a sector weight basis, what Pender has historically focused on, where we find the best opportunities, where that core circle of competency does lie, is in the technology space. So right now, between information technology and also our healthcare and communication services sector weightings, which are predominantly technology companies as well, in excess of half of the fund at this point is invested in small cap technology businesses. And what this sell-off and the extended period of underperformance of small caps has allowed us to do is really increase the quality of the fund. So investing in those best businesses that we think have great fundamental outlooks, high organic growth, good management teams in place, are trading at attractive valuations, and that we believe can perform positively over a multi-year period. And that's really where we want to allocate our capital to. And that's the shift that we've made in our portfolio, is increasing that technology weighting to take advantage of that opportunity present in the market today. You can see relative to the S&P 500, the TSX Comp, the TSX Small Cap Index, and the Russell 200. So, Pender's performance and the underperformance that we've seen within the small cap space in the short term, but over the long term, on a 3-year, 5-year, and more so on a 10-year basis, very strong performance out of the small cap fund and within that small cap universe. And we're seeing a very similar setup today as we saw in early 2020, 2021, where small cap valuations are quite undervalued, and there's a lot of pent-up demand and potential for small caps to outperform looking forward over the next 12 to 24 months. In terms of the activity that the fund's undertaking, we're really focusing on Canadian opportunities. The fund invests in both Canada and the US, but Canada being our backyard, an area that we're seeing more depressed valuations, more attractive catalyst-oriented companies, and part of the market where a lot of technology companies have gone public and are trading attractive valuations. It's an opportunity for us to revisit and kind of increase our exposure to those Canadian names. So that's something that the fund has currently been undertaking quite actively. On a year-to-date basis, we've had some strong contributors across a variety of sectors and companies, businesses like Blackline Safety Corp, Well Health Technology, which is in the health tech space, and WeCommerce Holdings. In terms of where we've seen some detraction, it's been more consumer-oriented companies. As you can imagine, with interest rates going higher, inflation high, consumers are a bit stretched. So consumer discretionary businesses like a clothing retailer, Aritzia, have faced some headwinds. And then in terms of the actual activity within the fund, really we've done a lot of that work already to focus the strategy on the highest conviction opportunities. So it's much more about understanding those businesses, keeping up with management, and ensuring that those our thesis and the fundamentals come to fruition as we expect. So walking through a couple of examples and that are actually held by the fund. So one company I want to talk about is Sylogist Limited. So Sylogist is a company that provides enterprise resource planning or ERP systems for the public sector. So they sell their software solutions to public sector businesses and companies. This has been a holding within the fund. It's the top holding as of June 30th, a company that we've owned or followed for many years in the past. It's a very sticky business, generates a lot of cash flow on a consistent basis. You have a management team and a board that were refreshed in late 2020 to really refocus on this business and refocus on growing. And we've started seeing that come to fruition. So a lot of focus on sales and execution to drive organic growth. A part of the growth in this business has been generated by M&A, so making selective, opportunistic, accretive acquisitions. And now you have a new management team in place that are doing that as well. We think this business is reaching an inflection point, and the stock is very attractively valued, positioned for strong growth and to realize on that inflection. And then we also recently got involved. So, as I mentioned, that scuttlebutt approach to investing. Not only do we, do the actual analysis and speak with management to understand the business, but in some cases we'll actually get involved in situations as well. And in this case, we wanted to have some representation on the board, and we negotiated with the company. We came to a non-migration agreement, and a director was recently appointed that's been backed by Pender funds. So, not only being a passive investor, but getting actively involved with some input and influence on how this business ultimately runs is what we're trying to achieve with that director appointment. So looking at the fundamentals for this business, you can see that, on the revenue basis, we're starting to see some decent compounding of growth there. The share price has, inversely been underperforming. So that's an attractive setup where you're seeing growth improve, expectations of growth improve, inflect higher, while the share price is going down and the multiples re-rating. So an attractive setup where multiples could inflect quite significantly to the upside, providing generative and positive returns. So that's kind of a very unique setup that we like to see, with fundamentals improving while the valuation is getting more and more attractive. Another business to talk about is Copperleaf Technologies. So Copperleaf is a leading global provider of AI-powered enterprise decision analytics software. So they typically sell their solutions to utility companies. A very sticky customer base. They haven't lost a customer in their history. It's very high return on investment. They drive exceptional client retention, and they're a proven leader in this space with a very experienced management team. Pender has worked alongside this company for multiple years. This was a company that we actually used to hold privately within our venture fund. So a business that we've known through its life cycle, from a private business that's smaller to its public status out today, that we continue to invest in, and that just provides us with unique insights that the other market participants may not have, not having that holding period and not owning it both as a private and public company. Within the market landscape for Copperleaf, we see a very attractive total addressable market. It's expanding. There's multiple growth drivers ahead. There's new industry verticals that they can move into. The business is also very, low risk from our perspective. They have a low balance sheet, a very attractive valuation. Their business is mission critical to a lot of their customers. So, very attractive from that Trinity risk assessment. And their customer base is effectively almost recession proof. So just a very sticky, consistent ability for this company to generate cash flows and redeploy that into new growth verticals. We think it's a misunderstood company, like a lot of Canadian technology businesses that are highly undervalued and quite attractive. Again, looking at this setup, you'll see that the revenues have actually been compounding quite healthily, growth expectations improving, and there again, the share price and the valuation of this business have compressed. So an attractive setup where things are getting better, growth is improving, the outlook's improving, but the valuation is getting more and more attractive, and it's only a matter of time before that disconnect or that elastic can break, and one thing has to come back to reality. And in our view, we think that multiples for this business, for many of the businesses held within the fund, are likely to rate higher. So to summarize, we're releasing a significant opportunity for small caps today. Historically, small caps have outperformed long-term performance for large cap companies. And that's really, a setup that we see today, like the 2000s, where valuations are at trough or, all-time low levels, and fundamentals do not correspond to that. So, it's only a matter of time before that valuation gap is narrowed and these companies re-rate. The market opportunity that we're seeing today, we think it really sets up the fund and this small cap universe for a multi-year period of outperformance. And within, where we're focusing, what we're trying to achieve, small cap tech is certainly a key area of focus for us. It's our core circular competency. We're finding a lot of attractive Canadian opportunities within the small cap space. Our work is focused on understanding, doing a lot of research to who are going to be the winners, which business models are going to work, which management teams are incentivized and strategic and have the actual ability to execute and grow to become profitable. And then what are these catalysts that are going to unlock value within the small cap space as well? So can the business continue to compound value? Is it likely to mean revert its valuation to historic levels? And how can M&A re-accelerate and unlock some of that hidden value within these small cap businesses that are trading at all-time low valuations? Perfect. And, any questions?
Yeah, thanks for that. And just on a note, there is a Q&A question box in the bottom of your Zoom. If you have any questions for us to ask management, let us know in there, and I'm more than happy to ask, time permitting. My first one is, you guys have had more of your portfolio of companies acquired than any other fund that I can think of. Where are you seeing the capital coming in right now? Where do you traditionally see it, and what's your outlook there?
Yeah, so that's a great question. That really falls into my key area of focus. Within the small cap fund, I focus on more of those event-driven special situation opportunities. So it's understanding, where there's companies that have catalysts, that have the right conditions in place for them ultimately to be acquired. A big part of where we identify and find that is that private equity approach to public markets. So a lot of investors in the markets, they'll do fundamental analysis, they'll evaluate a business. But what we do differently is we also think about what is the private market value of a public company. So for those businesses that I mentioned, Copperleaf and Sylogist, we're also doing work to understand what are industry players willing to pay for that company? If they were to be sold, how much value would you be able to get? What are the incentives associated with that? What is the likelihood of that deal coming to fruition? And that's a big part of how we identify those businesses. What we're seeing today is that M&A markets are starting to reactivate, and there's more vigor, particularly in the small cap space. A large part of that is there's just a lot of capital within the market. So private equity firms, for example, have an excess of $1 trillion right now in their balance sheets that need to be deployed. If you're a private equity fund, a sponsor that runs it, you don't get your performance fees or any fees unless you spend that money. So there's a clear incentive for them to spend that capital, and public market valuations are far more attractive than private market valuations. So if they're going to do deals, which is their business, they're going to do deals in the public markets. So that's a big driver there. There's also a lot of capital within public companies as well. So it's about $8.6 trillion today, and that's higher than it was pre-pandemic, despite higher interest rates. So more capital within public companies to deploy that money. And it's a lot of larger businesses that are looking to gain competencies or the right capabilities to compete effectively. And we've seen that with the pandemic, where businesses move more digital technology. We're seeing that again with thematics like AI, EV, the repowerization within North America. So if you're a larger company, you need to acquire certain capabilities to compete effectively. If you can't build them internally, you're going to acquire them externally via M&A. And that's another big driver of what we're seeing in the M&A markets. For a deal to take place, you need the right incentives. So from a buyer's perspective and a seller's perspective. And given that underperformance of small caps, what we're seeing right now is that a lot of small cap shareholders are frustrated. They know their businesses is worth $1 instead of 50 cents, and they're looking to unlock it. So we're seeing more activists get involved, more strategic reviews being announced, and more pent-up demand. So you have a very motivated, incentivized seller, and also a very motivated, incentivized buyer. So it's just a matter of time before those deals are actually announced and come to fruition. And I think we're trying to position ourselves to be able to take advantage of that.
Yeah, and Jeff, as Amar's talked about, I think historically out of the 83 takeouts, a third has come from private equity and 2/3 have come from strategic buyers.
On that, you touched on AI. Just given how hot of a topic it is this year, are there anything that you guys are looking at right now, or what are you seeing in the space? Exciting things to look at, things to stay away from?
Yeah, I mean, it's certainly, very topical, but there's also a lot behind it as well. And, we're seeing a lot of businesses that we own, both within our small cap funds and then also within our venture private funds as well, really leveraging AI technology. And, it's in a variety of different ways. So for some companies, it's generative AI. So everyone, may be familiar with ChatGPT. But the big opportunity there is just improvements in efficiency and workflow. So companies that are involved in the legal space or have very human-intensive type businesses, there's ability to kind of optimize and improve productivity there. We're seeing it within the diagnostic health space as well. A lot of businesses that we either own or cover within the fund in that space of the market. You're starting to see the ability for, let's say, a conversation between a patient and a doctor be recorded, and then AI being able to assess what's been said through that meeting and actually determine, what are the potential issues that this patient may have. So there's also companies that we own like Copperleaf that's, really leading into AI. They provide kind of mission critical decision-making tools for utility companies. So you have a vast set of data that this company is collecting, and AI and generative AI and just the ability to kind of leverage all that data into making quick, assessment and decisions is something that's very valuable. So I think it's we're in the early stages of it, and there's still a lot of potential there, a lot of growth, and that also segues into that M&A component as well, where if you're a large business that you don't have that AI capability in house, you may seek to go out and acquire it. And if there's a small cap company that focuses on the industry or the sector or the niche that your business is focused on, they may be a target for an acquisition. And that's where we're also seeing opportunities as well.
Hey, Dave, you have more experience in the space than most. Do you have any questions or comments on the small cap space?
No, I've never seen the small cap space so disconnected from everywhere else. So I have my own theories on how that disconnection happened, but the only relevant thing is, how long does it last?
Good question.
You guys want to
Yeah,
take
I
a
mean,
I'm waiting for Hummer to take that first.
crystal ball question at the end?
Very good
Better still, here's an answerable question. All right. So what, in your view, ends the bear market in small cap? Like, is it interest rates? You know, what's your view?
yeah, so I mean, typically speaking, I mean, small caps usually lead out of a recession or kind of an economic slowdown, and that's because they're, you know, smaller niche businesses. They're more domestically oriented. The valuations are typically more depressed. They're, in the terms of the cycle, they're early cycle type companies as well that can kind of benefit from recovery and economic improvement. But more, you know, generally speaking, in terms of, you know, what's could be the catalyst to unlock that value and kind of remove that disconnect, it could be M&A, because these valuations that we're seeing are so cheap in certain parts of the market that you know, you're not paying for growth in many cases, and there's just natural M&A consolidators. In Canada, for example, in the technology space, there's two companies, Constellation Software and Enghouse, that they're in the business of acquiring software businesses. And if you're trading at a level of about 1 to 2 times recurring revenue, they'll do that acquisition almost any day. So, you know, there's a floor effectively in place where someone's willing to acquire you. You're not paying for growth. You have cash on the balance sheet. If that business doesn't re-rate, it's only a matter of time before shareholders throw in the towel and say, like, let's do a deal. You're not going to be able to unlock value. The market's not reflecting it. We want to exit. And we could see that more pronounced across a variety of sectors and industries. So that disconnect, you know, it's unlikely to be, you know, permanent. But, you know, M&A could be the catalyst that ultimately unlocks it.
That's a great answer. Thanks very much.
I think that's it from the question side for this. Amar and Ian, I really appreciate your time. I think it's really timely, especially for our clients. So thanks again for that. For those participating, there will be a replay. We'll send that out in a couple days, and everyone have a great rest of your day. Thanks again, guys.
Thanks for your time, gentlemen. Thanks for your time.